Hello everyone, welcome back to Stock Market Meridian. Today is 26th August 2026 and you're watching today's pre-market report. Let's begin with the global markets, starting with the US markets. Yesterday, all the major US indices closed in the green, although currently US index futures are trading in the negative zone. The big story was a strong rebound in technology and semiconductor stocks after recent selling pressure. And the timing is important because investors are now waiting for NVIDIA's quarterly earnings and the latest PCE inflation data. Technology stocks led the recovery. NVIDIA gained more than 2%, breaking a 7-session losing streak ahead of its earnings announcement. AMD jumped 3.4%, while Micron Technology gained 3.9%, Western Digital rose 3.7%, and Intel advanced 3.1%. Meta platforms also added nearly 1%. However, it wasn't a positive day for every sector. Retail stocks came under pressure. Dick's Sporting Goods plunged 22.6% after cutting its full-year sales and profit forecasts, while Nike declined 3.2% amid concerns over consumer demand. Now the next major trigger is the US PCE price index, which is the Federal Reserve's preferred inflation gauge. Investors will closely watch the data for clues about the future path of US interest rates. Markets are also looking ahead to Federal Reserve Chair Kevin Warsh's keynote address at the Jackson Hole Economic Symposium on Friday, which could provide further clues about monetary policy. So the US market picture is interesting. Technology stocks have recovered strongly, but investors remain cautious ahead of inflation data and key Fed commentary. Moving to European markets, the positive trend continued there as well, with all major indices ending in the green. Now looking at the Asian markets, Japan, China and South Korea markets have opened in the gap down zone. So overall the global setup for today looks neutral to mildly positive. But volatility could remain high because of US inflation data, NVIDIA's earnings and geopolitical developments. Now let's move to the commodities market, where crude oil remains a key focus. US WTI crude oil is currently trading around $80 to $82 per barrel, while Brent crude is trading near $87 to $89 per barrel. However, yesterday's Indian commodity market saw significant weakness. Indian crude oil futures declined nearly 3.6%, while natural gas futures also fell around 0.5%. In precious metals, Indian gold futures declined more than 0.2%, while silver futures remained largely flat. So, the key commodity takeaway is this. Crude oil remains the biggest market variable, especially with geopolitical risks surrounding the Strait of Hormuz. Now, let's check the ADR data. Yesterday, Reliance Industries ADR closed in the negative, while Wipro ADR remained almost neutral. But the broader picture was positive. ICICI Bank, Infosys, Dr. Reddy's Laboratories and HDFC Bank ADRs all closed in positive territory. The standout performer was ICICI Bank ADR, which gained around 2.5%. So overall, the ADR setup looks largely positive for Indian markets, with ICICI Bank showing particularly strong momentum. Now, here's another positive signal for the Indian market. Yesterday, FIIs were net buyers of 1,593 crores, while DIIs also remained net buyers with purchases of around 230 crores. The important point is that foreign investors turned strong buyers, while domestic institutions also maintained their buying support. Overall, this combination indicates a positive institutional flow setup going into today's session. Now, let's quickly look at the economic calendar. Yesterday, German GDP data came in positive. However, in the US, both consumer confidence and new home sales data came below expectations and previous levels. Coming up today, markets will closely watch important US data, including PCE data, GDP data, and crude oil inventories. And tomorrow, the focus will shift to US initial jobless claims. So keep an eye on these numbers because they could influence global market sentiment, bond yields, and the US dollar. Now let's move to the biggest geopolitical development, and this one could have major implications for global energy markets. The United States has taken aggressive steps to reopen the Strait of Hormuz, one of the world's most important oil transit routes. US President Donald Trump said that the US Navy has removed and detonated mines placed across international waters in the strait. The US has also warned Tehran that any Iranian vessel attempting to lay new mines could face immediate military action.
Trump also said the US Space Force is monitoring the strait around the clock, while surveillance continues over key Iranian strategic and nuclear-related sites.
US Defense Secretary Pete Hegseth also indicated that Washington has not ruled out military strikes around the strait or Iran if necessary to maintain open navigation. And the impact is already visible in oil flows. According to maritime intelligence tracker Kepler, Iranian crude exports through the strait have reportedly fallen from around 2 million barrels per day to approximately 0.4 million barrels per day under the US naval blockade. Adding to the risk, UK Maritime Trade Operations reported that an oil tanker off the coast of Oman was struck by an unknown projectile and suffered damage. The US has also imposed sanctions on 60 individuals, vessels, and front companies linked to Iranian oil trade and weapons procurement. Meanwhile, diplomatic efforts are continuing. Pakistan Army Chief General Asim Munir visited Tehran, while Oman's foreign minister also traveled to Tehran for discussions surrounding maritime navigation. So, for markets, the message is simple. The Strait of Hormuz remains a critical risk factor for crude oil, shipping costs, and global inflation. And the geopolitical and trade pressure doesn't stop there. Canada is preparing a strong response to fresh US trade measures. Canadian Prime Minister Mark Carney's government has announced retaliatory tariffs of up to 50% on selected US goods, starting September 8. Canada is also launching a Canadian $5.4 billion relief package to support workers, exporters, and businesses affected by supply chain disruptions. The move comes after US tariffs of up to 50% impacted around $20 billion worth of Canadian exports. Industries including plastics, electrical machinery, and wood and paper products are expected to face significant disruption. The situation could also affect the automotive sector and cross-border energy flows. Donald Trump has announced plans to potentially double tariffs on Canadian automobiles to 50% next year. In response, Ontario Premier Doug Ford warned that Canada could consider a 25% surcharge on electricity exports to neighboring US states.
With around 70% of Canada's total exports going to the US, the stakes are extremely high. The dispute could also create additional uncertainty ahead of the upcoming USMCA review. So investors will need to watch this trade conflict closely, particularly for its impact on automobiles, energy, manufacturing, and North American supply chains. Now coming to India's major updates. The disruption around the Strait of Hormuz is forcing India to rapidly diversify its energy sourcing, and one major shift is happening in LPG imports. In August, the US supplied more than 73% of India's LPG imports. India imported around 0.62 million tons of LPG from the US in August compared with 0.89 million tons in July. Meanwhile, supplies from traditional Gulf sources fell sharply. India received only around 1.4 lakh tons from the UAE and 60,000 tons from Qatar, while Saudi Arabia supplied zero LPG in both July and August.
India is also increasing LNG supplies from the US. US LNG shipments reached around 0.75 million tons in August. However, this diversification comes at a cost. Longer shipping routes, higher freight rates, and increased maritime insurance costs are raising India's overall energy import bill. While India is diversifying its gas imports, its crude oil strategy remains heavily dependent on discounted Russian barrels. India imported nearly 2 million barrels per day of crude from Russia in August, more than 3 times the volume from the second largest supplier. UAE crude supplies remained steady at around 0.61 million barrels per day, helped by infrastructure around Fujairah that reduces dependence on the strait. India also imported around 3.83 lakh barrels per day from Venezuela. However, replacing Russian and Middle Eastern crude with US crude isn't straightforward. The reason? Indian refineries are largely configured to process medium and heavy crude, while US crude is predominantly light and sweet. So India's energy strategy is increasingly becoming a balancing act between supply security, refinery compatibility, and import costs. Now let's look at an important update from the Reserve Bank of India. The RBI's August bulletin highlighted that the Indian economy continues to show strong resilience despite global headwinds. The key drivers are strong domestic demand, improving industrial activity, services growth, and a recovery in the monsoon. The stronger July monsoon helped Kharif sowing move closer to normal levels, while reservoir levels also improved toward their decadal average. Inflation remains relatively contained, with core inflation stable while improving liquidity is supporting credit growth and investment growth. Foreign capital inflows have also strengthened India's external sector position.
Interestingly, the RBI expects India to be less affected than Asian peers such as China, Vietnam, and Thailand by the additional 10% US tariffs.
High-value export sectors such as smartphones, pharmaceuticals, and petroleum products remain outside the additional tariffs. Foreign direct investment also improved, with Singapore, the Netherlands, the US, and Canada accounting for around 74% of equity inflows. So, the RBI's message is broadly positive. India's domestic economic engine continues to provide a cushion against global uncertainty. Now, let's move to the important company updates, especially the announcements that came after the market close. First update is Billion Brains Garage Ventures, the parent company of stockbroking platform Groww, is also in focus. Early-stage investor Ribbit Capital is reportedly looking to sell around 1.6% stake in Groww for approximately 1914 crore rupees. The floor price is set at 195 rupees per share, representing roughly a 4% discount to Tuesday's closing price. As of June 2026, Ribbit entities collectively held around 10.10% stake in the company. Despite the stake sale, Groww's business fundamentals remain strong, with robust client additions and improving operating leverage. Groww shares closed Tuesday 3.33% higher at 203.01 rupees and are currently trading more than 100% above their IPO price of 100 rupees. So investors will be watching both the block deal and the stock's strong post-IPO performance. Next is Welspun Corp, and this stock could remain in focus today. The promoter group, along with MD and CEO Vipul Mathur, is looking to sell around 2.4% stake worth Rs 1,417.5 crore through block deals. The floor price has been set at Rs 2,250 per share, around a 4.1% discount to Tuesday's closing price. But here's the interesting part. The stake sale comes shortly after Welspun Corp secured a massive $1.8 billion US pipe supply order. This order helped push the company's global order book to an all-time high of around $4.4 billion, or approximately 42,100 crore rupees. Financially, the company also reported strong numbers. Net profit jumped 42% year-on-year to 499 crore rupees. Revenue increased 15% to 4,081 crore rupees, while EBITDA surged 35% to 756 crore rupees. So today's key point is the block deal versus the company's strong order book momentum. Now here's an important regulatory update for Cipla. The US FDA conducted an 8-day follow-up inspection at Cipla's Pithampur facility in Madhya Pradesh from August 17 to August 25. At the end of the inspection, the regulator issued 7 Form 483 observations. Cipla said it will work closely with the US FDA to address the observations within the stipulated timeframe. This facility is particularly important because it manufactures high-value US inhalation and respiratory products. The market will now closely watch the final US FDA classification. This is especially important because the facility had previously received a warning letter in November 2023. So for Cipla, the next major trigger will be how effectively the company resolves these observations and what final classification the US FDA provides. Next, Varun Beverages is expanding beyond its traditional non-alcoholic beverage business. The company has approved the incorporation of Kiva Spirits and Company Limited, a wholly owned subsidiary focused on ready-to-drink and alcoholic beverages, subject to regulatory approvals. The new subsidiary will have 9 crore rupees paid-up equity capital. The company has also appointed Prathmesh Mishra as CEO and Managing Director. Mishra brings more than 30 years of industry experience, including senior roles at Diageo and Pernod Ricard India. At the same time, Varun Beverages is strengthening its international presence through Varun Beverages Tunisia SA. VBL will hold a 75% controlling stake, with local partner Bevanda holding the remaining 25%. So the broader strategy is clear. VBL is expanding both its product portfolio and international footprint. Now an important development in the electric two-wheeler space. Hero MotoCorp has been allotted more than 76.19 lakh convertible warrants by Ather Energy, representing an investment of nearly 960 crore rupees. Each warrant can be converted into one Ather equity share at rupees 1260 per warrant. Hero MotoCorp has already paid around 240 crore rupees, representing the mandatory 25% upfront payment. The remaining 75% will be paid when the warrants are converted. This transaction follows Hero MotoCorp's earlier board approval to invest up to 1,000 crore rupees in Ather Energy. The strategic importance is significant. Hero is strengthening its presence in India's EV ecosystem while continuing to build its own Vida electric vehicle brand. So this is more than just an investment. It strengthens Hero MotoCorp's long-term EV strategy.
Next, Sai Parenterals has secured a renewed long-term contract through its subsidiary Numed Pharmaceuticals Pty Limited. The agreement is worth approximately AUD 30 million or around 204 crore rupees. The 3-year contract begins from August 24, 2026 and covers the supply of OTC medicines and finished dosage products to a major Australian pharmacy chain. The deal strengthens Sai Parenterals' presence in the Australian and broader Asia-Pacific healthcare markets. For investors, the key takeaway is multi-year revenue visibility and stronger international exposure. Next, NBCC has secured a domestic order worth 121.74 crore rupees from the Rajasthan Council of School Education. The project involves constructing 170 new school buildings across Rajasthan to replace old and dilapidated infrastructure. The project will be executed under NBCC's project management consultancy model. This adds to the company's already strong order pipeline, with its standalone order book standing at more than 1.12 lakh crore rupees. So once again, NBCC is strengthening its long-term revenue visibility through steady government and institutional orders. Next, ARSS Infrastructure has secured a 104.06 crore contract from East Coast Railway. The project involves replacing railway level crossings with modern road-over bridges across the Khurda Road division. The project has an execution timeline of 24 months. The development should improve railway safety while reducing congestion and improving passenger and freight movement. So this order provides another boost to ARSS Infrastructure's domestic railway project pipeline. And finally, let's look at the cement sector, where pricing action is once again becoming important. Cement producers have increased prices by around 10 rupees per 50 kg bag across key South Indian markets in August. The hike is primarily aimed at offsetting higher packaging and freight costs. Prices remained broadly unchanged across Andhra Pradesh, Telangana, West, North and East India, while Central India saw a marginal decline of around 3 to 4 rupees per bag. This follows an average price increase of around 15 rupees per bag during Q1. Analysts estimate that cement companies may need cumulative price hikes of around 35 to 40 rupees per bag across Q1 and Q2 to fully offset rising costs. Therefore, investors will closely watch pricing discipline and demand recovery after the monsoon season. And that's all for today's pre-market report. If you found this video helpful, don't forget to like, share and subscribe to Stock Market Meridian. And I'll see you again this evening with today's post-market report. Thank you for watching. Signing off. Jai Hind.